Missing by about 500,000 jobs. We're in this pandemic period still. Those extra unemployment benefits from the federal government have not yet rolled off, but will here next week. What do you read into about what the report is telling us? Is August an anomaly or the beginning of a softening labor trend?
So first, I'm going to say that to me, it actually wasn't as big of a shock as, for example, the April employment report. We were looking for 570,000 jobs, but frankly, we sort of knew that risks were skewed to the downside based on some of the big data indicators. I think, the question you have to ask yourself, should we be extrapolating from this weakness? And I think the answer is absolutely not. Nothing in this report to me indicates that there's been a weakening in labor demand. This is 100% about labor shortages. In fact, this report was very reminiscent of the April one, where we had very weak hiring and very strong wage growth. By the way, today, that was the strongest wage print since that April report. And again, to me, that's fully consistent with weakness in labor supply. We know from claims data that people are finding jobs. So the only way to reconcile these two data points is I think a lot of people are quitting. And Delta probably plays into that to some degree, because if you're not happy with your job and you think that you're going to be able to easily find another one and you sort of get hit with this spike in Delta infections, I think it's a great time for a lot of people to sort of sit it out, quit, and use that time to find another job. And I think that's precisely what happened in August.
Very interesting. Seth, what do you make of those numbers? Do you agree with Annetta, or do you look into the details and see something else entirely?
So I wouldn't say something else entirely, a bit of a disagreement, but broadly, I completely agree with Annetta's point that this report does not tell you something about the underlying trend for the economy. The jobs report was bad. I think there are no two ways about that, but it does not throw the medium-term outlook out of the window. I think first, the shortfall relative to expectations came from leisure and hospitality, and then education. I think the leisure and hospitality you can very clearly attribute to the Delta variant surge. And then with education, there's lots of uncertainty about schools. And so I think that gives you some confidence that it's near term. I think where I would differ a little bit is on what it means with the wage and how to interpret the wage inflation. So average hourly earnings were high this time, as Annetta said, very high back in April. Part of that is almost surely being accounted for with this composition effect that the missing job probably primarily among those lower wage paid workers, especially in hospitality and leisure. That's one of the categories where average hourly earnings was really, really big. And then when it comes to the underlying trend and why I'm less worried about labor supply, prime-aged labor force participation actually ticked up again. It ticked up again like it has for the past 3 months. I think that's an underlying trend that as the expansion, as the recovery continues, will get people coming back into the labor market.
So Seth, if the actual jobs miss was temporary and going to see a big bounce back, why did you guys downgrade your Q3 GDP so significantly earlier this week?
Yeah, that's great. So earlier this week is exactly right, and we, like consensus, though missed the jobs number this morning. That downgrade was driven off consumption. We are seeing a slowdown in overall spending in the economy. We know from equity analysts that covered the automotive sector at Morgan Stanley, August was probably the trough in terms of automobile spending. Those big ticket items matter a lot as more and more of this federal support starts to unwind. We had a slowdown in spending. We too think that's temporary. We're looking for Q4 to step back up a little bit from Q3, but there's just no two ways about it. The U.S. economy peak quarterly growth was already in Q2. We're going to have a slowdown. I think markets are looking for anything to react to, and so there's a bit of a temporary near-term impetus for slower growth.
Annetta, if I can get your take briefly on what you believe we may see when the federal unemployment sort of sweeteners, the incentives, do roll off next week, and how that will play out in the unemployment numbers, if you believe that we'll see labor coming back into the labor force and into these jobs numbers after that happens.
Yeah, I do expect to see a pretty notable pickup in the pace of hiring in September and into October. Look, I'm not suggesting that every single person that's going to lose benefit will find a job within 2 months. But what we've seen in these early states is that about 1 out of every individuals losing benefits, ended up in employment by early August. So if you sort of apply that ratio to the remaining unemployed, it would suggest that about 1.25 million people will have jobs, and that's sort of on top of the baseline. And then in addition, if schools reopen, which it looks like they're still on track to reopen, obviously there's still a little bit of a risk there, but that's roughly another million individuals who've been self-reporting that they cannot work because of child giving responsibilities, and so I think we'll see those folks return to the labor market as well. So I think some of the labor supply issues that have been holding back the pace of hiring will really start to dissipate during the next 2 months.
Annetta and Seth, thank you both for joining us. Good to see you.
Thank you.
Still ahead, housing prices remain elevated in America, but a new report from Redfin says homes are taking longer to sell. We'll talk about the potential slowdown for the red-hot real estate market with the CEO of Redfin. That's next. You're watching Closing Bell on CNBC.